We continue with our discussion on the cash flow statements, and in this particular section, we're going to look at a few sample cash flow statements and just try and understand if we look at the three major components of the cash flow statement, which is the CFO, CFI, and CFF, cash flow from operations, investing, and financing. Can just by looking at these three components, we get a sense of how the company is doing. What are the key observations around the company that we have, and if the company is doing well or not doing well when we look at these numbers, right? Now, typically in these three, the most important one that shows the company's well-being is the cash flow from operations. So if this is good, it shows the company's well-being in the current sense, right? Today, what's the company doing? Cash flow from investing is basically going to show about the future of the company, whether they have enough resources that they have put in terms of developing something from the perspective of future. And cash flow from financing essentially is in a way your capital structure. So what are you doing with the money, and where are you getting that money from, and how much money do you need essentially? So the final one is basically in the context of risk analysis, that if cash flow from financing, this is the portion that is going to tell us about the debt. Cash flow from investing is basically going to tell us about the future in terms of if the company has done any sort of capacity expansion that will come here. And operations obviously is the operating scenario of a company at any given point of time. So when we look at this, all we need to do is we take a company and we take these three line items of that particular company, right? So let's take a simple cash flow analysis for two of India's IT majors, the two major IT sector companies of India. If you look at these companies, TCS and Infosys, and we have about 7-8 years of data that we look at. If you look at cash from operate, and all this data is in rupees crore. So if we look at something like a TCS, for example, all these years they generate significant amount of cash flow from operating activity. So the company is very clearly profitable, no problem around that. Then you see money being given in cash flow from investing activities. So they seem to be doing, increasing capacity. And remember, these are zero debt companies. They don't carry any debt as such, right? Because IT is a business that does not require too much capital intensity. So even for capex and all, you don't need too much debt. So most of the cash flow from financing, which is a negative amount, is actually a dividend payment, right? So this is a dividend payment. And you see, every year they generate a lot of cash. Some of it goes in investing, the remaining goes in dividends. In these couple of years, they probably raised some money as well. But most of the years, they have a certain amount of cash. Some goes in capex, some goes in dividend, and they're left with some more cash, right? So it's a very, very healthy kind of a scenario. Even look at Infosys for that matter. Every year is a positive CFO. So CFO is positive. You have investing activity almost every year is negative, which means you have done some capex. Negative remember, means outflow, with the exception of one of these years in between where they may have sold some investments. Financing activity is negative, which looks like a dividend every year because again, these are zero debt companies. And yet every year there is some positive cash flow that keeps coming, right? So practically, these companies seem to be healthy. Why they are healthy is because of high cash flow from operating activities and no debt, consistent or continuous dividend, consistent dividend payment, and we know that they do not have any debt. We can check if they have any debt, but usually if you have debt, then cash flow from financing activity numbers will turn positive for a company, right? So just looking at these three items, regardless of what the profitability is, looking at these three items, you get a sense on, how much the company is able to generate in cash perspective, and how much they have actually invested and how much they have paid out as a financing activity, right? Now, let's look at a couple of other companies now. We get into GMR Infrastructure and we look at Suzlon, right? So these two are companies which are capital intensive. They are heavy in terms of businesses. Now, when you look at these companies, interestingly, you will find there is a cash flow from operating activity which is positive for GMR Infra. Cash flow from investing is negative, which means there has been continuous capex that they've done. And cash flow from financing is positive, which means they've taken a lot of debt. No one is going to give you equity every year. So effectively, you have taken a lot of debt, right? Now look at this in the last few years. If you actually add up this 8,000 plus 4,000 plus 8,000 plus 5,000 plus 10,000 plus 5,000, this is all debt, right? So this itself amounts to about close to 40,000 crore of debt. And if you add this up, that's 40,000 crore debt that the company has raised. And if you simply take a simple interest rate, right? Government of India borrows at 7.5%, 8%, so GMR should be borrowing at 10%. You're looking at a 4,000 crore interest cost, correct? Now, if you look at this company carefully, in none of the years, they have made 4,000 crore of operating cash flow. So how are you going to pay the interest in the first place, right? So this is a company that is in serious trouble because they have done a lot of capex, aggressive capex led by debt, and hoped that when their extended capacity comes on stream, they will make a lot of cash flow from operating activities that would result in giving them money that would repay. Now they're not making a lot of cash flow. They're making 3,000 crore, 1,300 crore, 3,000 crore. But the reality is that debt itself the interest cost itself should be about close to about 400 crore or so. So effectively, that's a very, very dangerous situation to be in, right? Look at the next one, which is Suzlon. Once again, debt, 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 and huge capex in these few years. So again, you see debt-led capex, and now we know that Suzlon at this point of time had filed for bankruptcy somewhere in between, right? So effectively, if you keep taking a lot of debt, that will keep appearing here. Your cash flows might appear positive, but that's because you've raised a lot of debt, right? And that doesn't help because at some point of time, see, eventually your cash flow from operating activity has to fund everything else. You can't live on someone else's money endlessly. That's what seems to be happening here. That's what seemed to be happening for all these years. Then obviously they kind of got their act together, started repaying some money, but you see that they do not have enough cash flow from operating activities to be able to logically take care of that entire debt, right? So what is extremely important when we look at these three line items for a company is that these cash flows become very, very relevant, and we're more and more focused on cash flow from operating activities as compared to the other two. This trend analysis, where we can get a sense on how much a company has invested, how much have they borrowed and invested, how much are they going to repay in a particular year, can all be done by just looking at these three line items. All we need to do is put these three line items for every company for the last few years, and we can get a sense on whether the expansion has been led by debt, whether the expansion is coming from their own money that they have generated in terms of operating cash flows, or whether the expansion is coming because they have uh, they have been able to raise a lot of debt or equity, right? Now, effectively, what happens in most of these situations is if things do not turn around, right? If we look at this set of cash flows, effectively, if things do not turn around, you do have to repay debt. So what follows is effectively selling off assets, right? So you take a lot of debt, you purchase all these assets over these years, and all that happens is in the next few years you start selling all of them because you don't have enough money. So how do you repay the debt? right? So if you look at GMR, if you look at JP Associates, all these companies in India which have taken a lot of debt. We've read a lot about Indian companies being in trouble with debt. All these companies have taken a lot of debt, done aggressive capex. Even if you look at something like JP Associates as an exercise, just try and look at the same three statement for JP Associates. Try and look at the same three statements for someone like a Future Retail. Every company that had a huge debt-led expansion resulted in significant issues at some point of time, and then they had to go ahead and sell their investments or investing assets in order to repay the debt that was there, right? So that's been the clear trend for most companies in India that you have to be careful about, right? Some other analysis that you can always do for a company that whose cash flows are available are basically you could calculate some ratios, right? So you could have a ratio of, typically in all the ratios we are more concerned about cash flow from operational activities, right? Operating activities. Why? Because that's the most important part. That's your business operation, right? So CFO divided by net revenue, CFO divided by average total assets, CFO by shareholders' equity, CFO by operating income, and CFO minus preferred dividends divided by number of shares outstanding. See, effectively, you're trying to find out what is the cash return on assets, cash return on equity, and not the net profit. Net profit may not be achieved unless you receive the money, right? So one of the most interesting things is cash to income, right? Your operating income, which is your EBITDA, for example, you can compare this to the cash flow because practically your cash flow from operating activities, your cash flow from operating activities has got to basically at some point of time be closer to your EBITDA in terms of trends, right? You can remove the tax bit, but other than the tax bit, uh, it has to be clear or closer to your EBITDA. It can't be possible that your EBITDA consistently grows and your CFO consistently declines, right? If you see this as a trend, then there is a problem. Then there is a problem. The company is probably selling something, but it is not receiving that money. Some of the other ratios that we look at are also going to basically say what is the broad return that the company is generating on a cash basis, right? So cash flow divided by average shareholders equity, cash flow divided by average total assets, cash flow to revenue, right? Just like we calculate net profit margin, which is the net profit divided by revenue. Here we are trying to calculate whether how much cash have you generated on a revenue basis, right? And finally, just like we are finding EPS, which is earnings per share, we are now trying to find cash flow per share, or in other words, cash flow from operating activities per share. And as we were discussing, CFO versus operating income, if we look at the cash flow, if operating income of a company is 100 over the next few years, then you could have a scenario like 1 year 70, next year 80, but the third year and the fourth year you have to recover the money that was stuck in the business. Over a period of time, you cannot have a scenario where operating income is consistently going up and EBITDA or your cash flow from operating income is consistently going down. That cannot be possible, right? Now, let's take a little bit of time and calculate some of these cash flow ratios for our company under question, which is Apollo Tires. Let's try and look at Apollo Tires and let's try and calculate all these ratios for Apollo Tires. So let's go to the balance sheet of Apollo Tires and cash flow statement of Apollo Tires. And what is the cash from operating activities? That's, if you see, for this year the number is 17,925 and last year the number is 9617.29, right? So let's put all these numbers. Cash from operating activities, and we can put these numbers from our discussion that we had on Apollo. Let's look at the annual report, 17,926, and I'm going to put the numbers just as they were in the annual report, and we're going to look at 9617 the previous year, right? So that's 9617, and we can calculate these ratios for 2 years. We can look at net sales right? We can look at shareholder equity. We can look at total assets. You can also look at average on these, but we're just going to look at numbers directly. And we can look at EBITDA, right? And we can look at the final number of shares that they have per share, right? So we can look at number of shares and we will get an idea. So we'll look at all these data points as to where we can find them. Let's also format all these and then we will be able to calculate all the numbers pretty quickly, right? Let's format this. So what are the net sales number? Let's put the net sales number that's here. We'll use the net sales number which is here. So 86164,88783. So let's put 86164 and 88783. Similarly, shareholder equity that's available on the balance sheet, total reserves and surplus plus share capital, B1 and B2 added, 39,964, 39,964 and 32,707. And then total assets, we can look at total assets is going to be the same as total liabilities. So 68,740. 68740. It's always a good idea to try and put these numbers yourself because then you become familiar with the company, you become familiar with the size and scale of the company you're working on. 61214, right? If you were to offhand ask me what is the sales of Apollo tires, I may not know it, but if I work like this on Apollo tires, then I will always know it, right? In this, we have profit before tax that is given to you, correct? 12,574. How do I reach EBITDA? How do I reach EBITDA? I will take this number and to this I will add the interest. So I will plus this and I will add the depreciation. So I will plus this, right? So 12,574 plus 2686 plus 883, right? So we're going to put these numbers in, is equals to 12,574 plus 2686 plus 883, correct? So that's the number we get for EBITDA. And similarly for the previous year, we get 9341 plus 2468, right? So we do 2468 plus 1721. So we get this number, right? And number of shares. How do I get number of shares? Typically, you can either calculate the number of shares by profit divided by EPS, that gives you the number, or in your notes to accounts, when you go further, your share capital will have a detailed number. So how many shares have they issued and subscribed is written here, right? So that's 509,024,770. If we are looking in millions, this number is 509 million shares, 509 million shares, right? So 509 million shares is what we are looking at, and we can put the number in here since all the numbers are in millions. 509 million shares. Now can we calculate the ratios? Can we calculate the ratios? So CFO divided by net sales, CFO divided by shareholder equity, CFO by total assets, CFO by operating profit, and CFO per share. Can we find this? That should not be very difficult. I will take this number divided by the net sales number, and we have to divide CFO everywhere. So I'll just freeze this and keep this constant. Take this all the way down. Similarly for this year, freeze this and divide by 783, sorry, and take this down, and we can put the percentage here. Right, now take a look at this. Obviously, most of the ratios have improved this year because cash flow from operating activities has gone up. One of the more important numbers is this. Remember, we said in 1 year it is possible that you make a profit, but you don't get all that money back, right? So effectively, in the first year, it seems they made a profit of EBITDA of 13,530, but they collected only 9,617. That may have been because receivables went up, inventory went up, something of that sort. Next year, they made a smaller profit but recovered more money in cash flow from operating activities, correct? So effectively, over 2 years, they have collected 182% of the total money. They should have collected 200%. Some is left, but that's okay. They seem to be selling more on credit in 1 year and then collecting some money next year, right? And these last two, sorry, are not on a percentage basis, but on a per share basis. Every share that you hold, the company generated 18 rupees last year, but 35 rupees this year. So this year's cash flow performance has been remarkably good. Even if you look at the cash returns on assets, that's been remarkably good for the company in this particular year. That's all we need to do. We need to just track these numbers year on year and see this, remember, is 2016 and this, remember, is 2015. So current year and last year, right? We just need to track this performance of the company year on year and try and gauge what do we understand looking at the trends. Are they generating enough money? Are they not generating enough money? And so on and so forth, right? That's all that we need to do with the cash flows. That's basically it with the unit 5 around cash flows. It's important to summarize some of this information. So just as we summarize this information, cash flows are very important in ascertaining whether or not the company is able to generate money. They might be profitable, but they might not be able to generate cash. Always remember that profit and cash are two different terms and two different numbers, right? And cash is a fact. Profit can have accounting policies playing into it, but cash is a clear fact that if money has come into the company, it'll appear there, right? So you can't really play around too much with the cash. So effectively, that's where cash flow ratios become very, very important. That's where cash flows become very important. And just by looking at the three different line items in the cash flow statement, operating activities, investing activities, and financing activities, we can get a fair bit of understanding about these companies, about how the company works, about how the business is, right? That's all that we need to know in cash flow statements. So couple of questions as we end this particular unit. Explain the use of the ratio cash flow from operations to operating income, and explain what can you understand by just looking at the trends in the three line items of the cash flow statements, that is CFO, CFI, and CFF. Thank you.